The current energy landscape revolves around renewable energy. With long-term repercussions in mind, the Philippine government has put out a moratorium on new coal plants. Energy companies have begun to shift to fully renewable energy. But this sharp focus on the far future puts our country's tomorrow at risk. An energy crisis is fast approaching. In 2024, 1 in 6 Filipino households will lose their access to electricity. In the next 6 years, that number will only continue to grow. Renewable energy is necessary, but the abrupt transition will leave too many of our countrymen in the dark. Avoitis Power offers a solution. We issue a buy recommendation with a 1-year target price of 43.7 Philippine pesos and an upside of 37.6% for Avoitis Power, one of the leading power generation and distribution companies in the Philippines. We ground our positive outlook on three catalysts, or AP's power moves. Its prudent capacity expansion, effective offtake strategy, and robust financial performance.
In line with the Paris Climate Change Agreement, the Philippine government is forced to expedite the country's transition to renewable energy. However, the approaching Malampaya depletion threatens 20% of the country with blackouts as early as 2024. Hence, regardless of the stringent ESG mandates, we believe that developing countries such as the Philippines cannot afford to fully and immediately transition to renewable energy. In fact, many European countries, even those leading the renewable transition, postponed their coal phase-out by not only reviving old plants, but also building new coal to cater. Thus, we maintain that Avoitis Power is uniquely positioned to address both the short-term energy crisis looming over the Philippines and the long-term energy trilemma of environmental sustainability, energy security, and energy equity.
The first catalyst to AP's upside is its prudent capacity expansion. With the continuous development of its already extensive generation portfolio, we expect AP to significantly profit from the power supply branch. The timely unveiling of its new GN Power Dingin plants has allowed AP to capture the immediate power demand in Luzon and position itself as the main beneficiary of the Malampaya depletion. Furthermore, its planned solar and wind ventures contribute to AP's pursuit of a balanced energy mix of 9,200 megawatts by 2030. The company's staggered clean energy execution optimizes past investments in thermal energy and stretches out high capital outlays associated with renewables. By 2030, AP's additional plants will be able to cover up to 61% of the unmet national demand, and this is on top of its already contracted capacity. Thus, AP's power move to concurrently maintain its thermal plants and develop its renewable portfolio enables the company to grow its capacity in time for the supply crunch.
The second catalyst to the company's upside is its effective off-take strategy. AP's tactical unloading of capacity cushions its bottom line from fluctuating power and energy prices. Given the enduring Russian-Ukraine war and the rising global consumption, we forecast coal to remain trading above $260 per metric ton in the next 3 years. This is significantly higher from its 3-year average price of $136 per metric ton before 2022. High and volatile input prices present threats to many companies' bottom line, but AP is different. AP creates opportunities. For fixed contracts, AP mitigates commodity price risks through its cautious hedging decisions and pass-through provisions. Case in point, AP evaded a 15 billion peso loss by initially sitting out on the bidding of a 10-year contract with MER. Unlike competitors, AP waited for available and reasonable hedges to protect itself from rising coal prices. The company also included fuel pass-through clauses to shift the burden of high input prices to consumers. For non-contracted capacity, AP holds the biggest share in spot exposure, representing 49% of the total traded power in the wholesale electricity spot market. Based on our forecast, AP is set to benefit from our projected spot price increase that is at least 26% higher than that of 2021. With 25 years of experience, AP's effective offtake strategy positions the firm to benefit from the rising commodity and power prices.
The third catalyst to AP's upside is its robust financial performance, propelled by its prudent capacity expansion and effective offtake strategy.
AP's expansion plan is set to provide an additional 4,547 megawatts over the next decade, filling the power supply demand gap on a timely basis.
As a result, there will be substantial growth in revenue from an increase in total capacity sold and from the surge in power prices. That being said, our projections show a 6.2% CAGR for total revenues in the next decade, with most of the growth attributable to the company's power generation segment. The Clean Energy Pipeline, which represents its renewable energy portfolio, is expected to have a 10.9% CAGR in the same period. Similarly, its non-renewable portfolio shows a decent 6.9% CAGR despite the legal moratorium banning the construction of additional coal plants. We also expect significant cost savings from its Digital Leap program and decarbonization efforts. As shown by the leftmost chart, the OPEX to revenue ratio is anticipated to decrease from 79% in 2021 to 75% in 2022, which will then be maintained over the next 10 years. The revenue growth rates and the cost savings translate to AP's leading profitability metrics. For the past 5 years, the company has been dominating the industry across all of the important margins. The 5-year average of its gross profit margin alone, set at 46%, overshadows the 24% industry benchmark by a landslide. Likewise, the company's other margins have also performed well above their own industry averages, fully showcasing the efficiency of AP. Given the company's financial performance, we anticipate earnings to grow by an impressive 10.3% CAGR for the next decade. As such, the company will have greater leeway to maximize shareholder returns. Besides providing energy stability and security for its consumers, Aboitiz Power is more than ready to provide value to its investors.
With these three catalysts, we arrive at a one-year target price of 43.7 pesos by discounting the free cash flows to the firm. Our WACC of 11.5% accounts for variable adjustments, including the multiple interest rate hikes in the Philippines. To reinforce our valuation, we also computed for supplementary target prices shown on the right side of the screen.
Further compared AP with its local and ASEAN peers. AP boasts an impressive dividend yield of 4.9%, which we assume to remain stable in the next decade as the company addresses the power crisis. In spite of the superior dividend yield, AP is trading at 10x PE, lower than average and nearly 3 times undervalued compared to ASEAN. The disparity between AP and ASEAN is a result of their diverging RE approach. ASEAN has transitioned to 100% RE, while AP remains committed to its 50-50 energy mix. Given the three catalysts and the company's relative undervaluation, we believe that now is the best time to buy AP.
With our target price in mind, we determined 4 main risks. We identify possible plant interruptions and high input prices as the most relevant. We note that AP's established systems, tested throughout its 25 years of experience, minimizes the probability of plant interruptions. It will take a 45% decrease in total revenue across the forecast period before we shift to a sell recommendation. Next, we note that the company's pass-through provisions and balanced energy mix protect AP from future coal price hikes. For the 10-year forecast period, coal price must sustain an 82% hike from our base price of $260 per metric ton for our recommendation to shift to a sell.
In terms of ESG, AP has the lowest ESG associated risk among its peers. AP may be seen as a laggard due to its careful transition to renewable energy, as opposed to the swift change enacted by its competitors. However, renewable sources alone cannot bridge the supply-demand gap from the incoming energy crisis. Thus, we see AP's transition as the most responsible option. With this, we can claim that AP's cautious transition simultaneously impacts the environmental and social aspects. The company is shifting to renewable energy without jeopardizing the energy security of millions of Filipinos. Furthermore, the board of Aboitiz Power is composed of educated experts in the field of energy. This manifests in their actions addressing the energy dilemma, especially in AP's thrust for total national electrification. All these factors combine to propel Aboitiz Power to the forefront of comprehensive ESG investment in the Philippines' energy sector. In summary, AP's prudent capacity expansion, effective offtake strategy, and robust financial performance all power our buy recommendation, and more importantly, power the Philippines in the face of the energy crisis. With the Voitis power, power moves. Thank you.